So imagine signing a $200,000 contract for a massive commercial build.
Right.
You do the work flawlessly, but you end up draining your personal savings just to finish it.
Yeah, that is a brutal situation.
I mean, I know a framer who lived this nightmare recently. He runs a highly profitable local crew. He locked his numbers into his bid back in November.
Oh, I see where this is going.
Yeah, he thought his math was rack solid. But by March, well, the lumberyard quote came back for the actual materials. It was 17% higher than his initial bid.
Wow.
And the contract did not move a single inch. He just had to eat that massive spike to get the job done. We want to figure out how contractors can bulletproof their margins today.
Well, that is a brutal reality for almost everyone in the trades right now. The 17% material cost spike between 2024 and 2025 quietly killed margins across the board.
It really did.
Yeah, lumber, steel, copper, and PVC all moved violently against fixed bid contractors. The bid was entirely fair when they signed it.
Yeah.
But the contract did not move when the market shifted. If anyone pitched you a fast bridge loan for a material shortfall recently, drop their numbers into the payment calculator at BusinessLoan.Directory. Factor rate over 1.20 euro or daily ACH means MCA, 60 to 200% APR. Free.
Because predatory lending is a huge trap when you're desperate to finish a job. Those ridiculous rates will just drown a business faster.
Oh, absolutely.
So we need to figure out why contractors absorb all this financial pain. Why not just pass it on to the project owner?
That is the big question.
Wait a second. I need to push back on this fundamental premise.
Okay.
If lumber jumps 17% overnight, well, why doesn't the contractor just slide the new receipt across the table?
Right.
If materials cost more, the owner should pay more.
Yeah, that sounds completely logical to anyone outside the industry. But most residential and small commercial agreements, they have no cost escalation clause.
Wait, really?
Yeah. Project owners demand absolute certainty for their own financing and budgets. They want a hard number before they break ground.
So that means the contractor signs a fixed price contract just to win the bid.
Exactly.
You are basically gambling that the market stays flat for 6 months.
You are. And material costs move between the bid and delivery, so the contractor absorbs every single dollar of that unexpected difference.
Man, you are doing the job of an insurance company for free.
It is actually worse than an insurance company. You take on all the market volatility without charging a premium for the risk.
Wow, that is a great point.
And we also have to look at what happens before the crew even shows up. Contractors already face a brutal 60 to 90-day mobilization gap.
Right.
This creates a massive cash flow void long before the first progress payment clears.
Let's unpack what that actually means on the job site.
Sure.
You have to pay for heavy equipment logistics out of your own pocket. You have fuel costs eating up hundreds of dollars every week.
Oh, yeah, constantly.
And your crew still expects a paycheck every Friday, regardless of when the owner pays you.
Exactly. You also have to pay surety bond premiums immediately to secure the work. Those premiums are often 1 to 3% of the total contract value. The cash goes out the door before you even buy a single 2x4.
So your cash flow is already stretched to the absolute breaking point.
It is. Adding a sudden material spike on top of that creates massive financial instability.
Yeah.
Absorbing a tiny bump in costs is one thing entirely. But the sheer scale of recent price jumps makes this structural flaw fatal.
If a contractor cannot absorb the cost, the project just dies.
Yep.
So let's look at the actual damage and how fast it eats a business.
We have to keep returning to the 17% material cost spike between 2024 and 2025.
Right, that was huge.
Lumber moved 17% almost overnight. Steel moved 19%.
Jeez.
And copper moved 23% on certain vital gauges. Tariffs hit 25 to 30% on various construction goods.
Let me run the actual math on how fast this destroys companies.
Okay, let's hear it.
Imagine that $200,000 framing contract I mentioned earlier. Let's assume it carries a 35% material cost.
Right.
That contractor takes a $12,000 margin hit on lumber alone.
Wow.
I mean, it is like a slow leak in a tire. You do not notice the damage while you are cruising down the highway.
That is a perfect analogy.
Then suddenly you hear the grinding sound, and you are driving on the bare rim. You stack those different commodities together, and the profit completely disappears.
Your profit for the entire month is just gone in an instant. That $12,000 was supposed to pay your personal mortgage.
Exactly.
It completely drains the lifeblood of the operation. Every week you wait while prices climb as margin you never get back. The money you already earn calculator at BusinessLoan.Directory compares the spike you absorbed against the rate savings of waiting for a cheaper loan.
Because delaying action just drains your bank account further while you hope for a miracle.
Right. Remember the MCA detector inside the payment calculator. Run any fast funding pitch through it before you sign.
You definitely have to protect the little margin you have left from bad debt.
Yeah.
Once that margin completely vanishes, contractors need immediate capital to survive. They need to bridge the financial gap safely without ruining their business long term.
This exact scenario is where a proper working capital line comes into play. Specifically, we are talking about Track A financing for contractors.
Okay, what do the amounts look like for that?
Amounts typically range from $25,000 to $250,000. The contractor draws funds right when material purchase orders run hot.
So it acts as a flexible financial shock absorber.
Exactly.
You draw the money to buy the lumber when the price spikes. Then you just repay the line when the next progress draws clears from the owner.
It smooths out the rough spots perfectly for a growing business. It is the exact same financial product that funds payroll during a tight month.
Oh, I see.
You just need a different use of funds memo when you apply. It is a very straightforward tool.
But what about larger and completely unexpected spikes? I mean, sometimes the working capital line isn't big enough. What happens when a massive project scope changes suddenly because the owner wants something different?
Well, that situation requires accounts receivable financing. This works perfectly against signed change orders right alongside your standard line.
Okay.
The contractor pulls in advance specifically to cover the sudden spike in scope.
So if the owner suddenly wants copper pipes instead of PVC, you need funding now.
Exactly.
The owner signs the change order to approve the new cost, but they don't actually pay you until those new pipes are installed.
Right. Accounts receivable financing provides that liquidity instantly based on the signed paper. They repay the advance when the owner finally pays the change order.
That makes sense.
You essentially use two products to solve one single problem. It keeps the project moving forward without stalling the entire crew.
Getting this dual product capital requires serious speed to be effective.
It really does.
I mean, if you wait 8 weeks for a bank, the job is already dead. That means having the exact right paperwork ready immediately. It is basically like passing a building inspection. If you do not have the right permits visible, the inspector fails you immediately. You must prepare the package first.
That is the perfect way to look at the application process. There are 5 specific items required for a complete package.
Okay, what are they?
First, you need 3 months of business bank statements.
Why only 3 months? A traditional bank usually wants to see 2 or 3 years of your financial life.
Alternative lenders just need to see recent cash flow consistency. They want to know you are actively working right now.
Got it.
Second, you need your last year business tax returns.
Wait, just the most recent year is actually enough?
For this specific fast track program, 1 year is plenty.
Oh, wow.
Third, you must include a driver's license, front and back. Identity fraud is a massive issue in construction lending right now.
Yeah, that makes sense.
Fourth, provide a voided business check to establish the funding account. Finally, write a 1-paragraph use of funds memo naming material cost coverage.
Just one short paragraph explaining the material cost issue. You do not need a massive 50-page business plan.
No, keep it incredibly simple and direct. Underwriters just want to know the money is solving a temporary problem.
That is amazing.
That specific package moves the file in days rather than months. This completely avoids the 4 to 8 week wait you get at traditional banks.
Because speed is absolutely everything when material prices are spiking daily.
It is.
But, even with perfect paperwork, underwriters still have to evaluate you. They look at 3 specific metrics to actually approve your file.
They do.
So how can you know if you actually qualify before applying? Nobody wants a surprise rejection after doing all that work.
Skip the long application and the rejection. The 3 big C's live score inside the payment calculator at BusinessLoan.Directory uses the capacity, capital, character framework underwriters use. 60 seconds. Reveals which letter is blocking you.
That is incredibly useful for business owners who hate wasting time. Let's break down those 3 big C's in detail so we know the math.
Sure. Let's start with the first C. Capacity means your cash flow measured against your debt service.
Okay.
A debt service coverage ratio above 1.25 unlocks standard bank pricing.
Let me make sure I understand that ratio mechanically.
Yeah.
It means your operating income is 25% higher than your monthly debt payments.
Exactly. Underwriters want to know you can handle new payments safely without suffocating your business.
Right.
That buffer proves you are not living dollar to dollar. Now consider the second C. That stands for capital.
If capacity is about monthly cash flow, um, I am guessing capital is about reserves. It must be the actual depth of your safety net.
You got it. Capital means your overall working capital depth. The line raises the balance sheet number lenders read first.
So it shows financial resilience during tough market conditions.
Exactly. Lenders love seeing a business that can take a punch and keep standing.
And the final C is character. How do they measure something as subjective as character? Do they call your previous clients for a reference?
No, character relies heavily on your actual FICO score. A FICO score above 700 opens the full menu of lending options.
So keeping your personal credit clean gets you the cheapest commercial money available.
Yes.
What happens if a contractor had a rough year and their score dipped?
Scores from 650 to 699 route to SBA programs. Those take longer but offer great terms.
Okay.
Scores below 650 route directly to alternative lenders. Knowing these exact requirements allows a contractor to prepare their business profile intelligently.
So you can fix your metrics before the next crisis hits your industry.
Absolutely.
Let's talk about the ideal preparation timeline. The framer who survives the next spike does not wait for a crisis. He plans ahead and applies well before the busy bid season even starts.
Yes, building the perfect borrower profile takes real discipline over several months. Your business bank account must be completely separate from your personal funds.
Right, you cannot mix personal grocery bills with business lumber purchases.
No, underwriters will run away if they see a messy, commingled bank statement.
Yeah, that makes sense.
Overdrafts must be gone entirely from your history. Your revolving credit must be clean and current. Underwriters absolutely love a boring and highly predictable financial profile.
So the smart contractor files for the line in January when things are quiet. They get the boring paperwork done early in the year.
Exactly. By March, the 17% material cost spike between 2024 and 2025 repeats itself.
But this time, they are ready for the hit. The line is already open and ready to deploy.
They are fully protected from the market chaos.
They do not have to eat the cost and drain their savings this time.
It truly changes everything for their margins and their mental health. There is one final provocative thought you should consider today.
Oh, what is that?
Tracking the material price index is absolutely crucial for your survival. Tracking this index allows contractors to predict spikes accurately before they happen.
Oh, wow. So you can see the wave coming before it ever hits the lumberyard.
Exactly. You can secure your capital and act before the entire market reacts.
And think back to that framer from November. Do not let yourself be the one driving on the bare rim. Act before the market forces you to close your doors. Free. No email at first level. No credit check. No obligation. Right capital at the right time.